let's do a couple of these transactions just to walk through and give you an idea. And see how they do it here. I'm going to do it a little differently because I like to do T accounts. So I'm going to go through and I'm going to write each of these in. I'm going to use the T accounts. And it's going to be the same transactions that we're talking about here on page 16. So let's take a look at the first one. Okay, that's on page 15. That's where you had a $15,000 investment in the business in exchange for $15,000 in cash. So you read through that and you say, okay, well, what accounts went up and what accounts changed? Well, the first one that went up is cash. Cash is an asset. So what I'm going to do is I'm going to make a $15,000 entry right here. The other side, it wasn't a liability because I don't have to pay it back. It was an investment by a stockholder. So I'm going to do a $15,000 credit to show that increase. It's actually going to be in common stock as the account it's in. The common stock is a stockholder's equity account. So that would be how I would record that transaction. And they show it in a little bit of an equation format. I'm just doing it in a T account. So you guys did T accounts in chapter 2, right? So, yeah. On transaction number 2, you purchased equipment for cash. So what went up and what went down? Assets went up and went down. In this case, they're both on the same transaction side. You bought a piece of equipment for $7,000. So what's going to happen is you're going to see cash go down by $7,000 because it reduced, that's a credit, and you're going to see equipment go up by $7,000. So in that case, nothing was affected on the other side of the equation. It all happened on the asset side. And again, they break it out and give you the equation format. I'm just going to do it in the T account format. On transaction 3, what they do is they go through. That was a little trickier because they go through and you're purchasing something, supplies, and you're not going to use them all at one time. Plus, you're also not going to pay for it now. Okay? And they talk a little bit in there, and we'll talk more about that, the difference between cash basis and accrual basis. But when we go through and we have an exchange of value, but the cash hasn't happened, we have to go through and record that transaction even though cash hasn't happened. You and I, in our checkbooks, we don't put cash in until we receive it, and we don't take cash out until we write the check. But businesses have to use something called the accrual system, which means if the transaction has happened, but the cash is happening at a different time, you still have to record it. Chapter 3 will get into accruals and deferrals. But this is an example where you've received an asset because they've actually given you the supplies, but you have an obligation to pay in the future. So in that case, what's going to happen is you're going to have an increase of an asset. That asset is supplies. It's going to be $1,600. So you're going to debit it because the value went up, but you have an obligation to pay, which is a liability, and so you come over here and you have to show the increase in the liability by putting it into the accounts payable section. And accounts payable is where you owe money for purchases of items you're going to use in your regular business. So it could be supplies, it could be merchandise you're going to sell to your customers, it could be things that definitely something you're going to use for your business in the near future, but you haven't paid for it yet. Okay?